Okay, we've completed most of our discussion about cost behavior. So the next thing to address um, is discussing cost behavior as it relates to volume and quantity. And let's consider it by looking at a financial statement. In looking at these, this is right out of your book. I think there's a page in your text that shows this same data. The traditional and contribution margin formatted income statement. The one on the left you are likely familiar with because it's a very traditional, albeit overly simplified, statement that shows sales of $100,000, cost of goods sold of 70, gross margin or gross profit. I don't like the term gross margin in the form of dollars. You will hear from me. When I say gross margin, I'm talking percentage. When I say gross profit, I'm talking dollars. So I may be a little anal retentive, but that's my style. And selling and administration expenses are $20,000, leaving a net operating income of 10. Now let's talk about this 70,000 and this cost of goods sold for a moment. If this was a merchandising company like Nordstrom, that $70,000 would be the cost of the Jimmy Choo shoes and the Tommy Bahama shirts and the DKNY dresses and all of the stuff that they sell there at their cost, selling it at their sale price and making X money. If this was the manufacturer of those goods, like the manufacturer of a phone or a Tommy Bahama shirt, this $70,000 represents direct material, direct labor, and manufacturing overhead. That is the product cost associated with their products that they sell. So I'm just trying to separate that. And the selling expenses, just to reinforce, those selling and administrative expenses are period costs. So just rehashing a few things that we talked about in earlier sessions. But I have a question for you. Looking only at the traditional format, what's going to happen to net operating income if sales increase by 10%? Think about that for a moment. If sales of $100,000 increase by 10% to 110, what's going to happen to net operating income? Okay, I think a typical response that might come from you is, it's going to go up. And you'd be right, it's going to go up. But let me be a little bit more specific. How much is it going to go up? Think about that. I'll agree with you. If it goes up 10%, sales go up 10%, net operating income is going to go up. But by how much? Is it going to go up by 10% too? Is it going to go up by 5%? 15%? How much? Don't even try. You can't figure it out. Some of you may be pretty observant and say, well, wait a minute. If they're making $30,000 on 100, that's 30%. So if sales go up by 10% or $10,000, the bottom line should go up by 3,000. So my net operating income is going to be 13. Maybe. It's a good try, but here's the problem. Could any of you tell me how much of this cost of goods sold or how much of this selling and administration expense is fixed and how much of it is variable? You can't, because you don't have to. Under GAAP, generally accepted accounting principles, and what gets reported to the outside world and in a publicly traded company, which goes to the SEC every quarter with a 10Q and every year with a 10K, this is the type of format. It's called absorption costing, which we will get into in future chapters. But you can't distinguish variable costs from fixed costs. You can't tell how much it's going to go up. You do know it's going to go up, but you don't know by how much, but you could guess. So we've got 13, that's my guess, or our guess, or one of yours guessed it. We'll now turn your attention to the contribution margin statement, which, by the way, is never shared with the outside world. This is an internal document, typically developed internally for management to evaluate their cost structure and evaluate what changes in volume or sales will do to profit. So now I'll ask you that same question. If sales go up by 10% or $10,000, what will happen to net operating income? So with that question, let me illustrate something for you. Notice that the variable costs here are $60,000. And you know, because of this curve, that if I sell additional sales, my variable costs are going to go up. And they will go up. But you also remember that the unit cost is the same. Having said that, since these variable costs are 60% of sales, I know that my variable costs are also going to go up by 10% because they must track linearly with changes in volume. So if sales go up by 10%, my variable cost is going to go up by 10%. Well, if my variable cost goes up by 10%, my contribution margin, which is the difference between sales minus variable expenses, is also going to go up by 10%. So that contribution margin is 40%. So let's think about that. What is this contribution margin thing? Well, I'm going to draw one more picture. I'm not an artist, but that's a bucket. And this bucket holds $30,000, representing my fixed costs. So what is the contribution margin? The contribution margin is the profit and the margin that I've earned over my variable costs. So if I were to pour $40,000 into a $30,000 bucket, I'm going to overflow and $10,000 is going to come out representing my net operating income. So think of it as my contribution margin has to at least cover my fixed costs in order for me to have a profit. So taking my example, if sales go up by 10% and the contribution margin goes from 40,000 to then 44,000, I know if my sales goes up by 10%, my net operating income is going to increase to $14,000.